Going on, everybody? Wise Investments here, and today I'm going to be walking you guys through the basics of how to get started with investing in Canada. So, to start it off, before you even begin to look at how to start investing, there's a few things you're going to have to consider. I pulled up this article on getsmartaboutmoney.ca and we're going to walk through it. So, the first thing you're going to have to consider before you're getting into investing is you need to ensure you have a clear what's going on, everybody. Wise Investments here, and today I'm going to be walking you guys through the basics of how to get started with investing in Canada. All right, so we'll get right into it. before you start in, Before you start thinking about getting into investing, there's going to be a few things you have to consider. All right, the first thing you're going to have to consider is your cash flow. You have to ensure you have a clear sense of your monthly cash flow or budget so you know how much you have available to save and invest each month. You have to be sure of how much you have coming in and how much you have coming out and how much you're going to have left over to invest every month basically. The next thing you need to consider is how much you owe. If you have high interest debt, it may make sense to pay this down before investing. All right, the next thing after that, how much risk can you tolerate? The risk return relationship is important for any investor. Generally, the higher potential return of an investment, the higher the risk. But there's no guarantee that you will get a higher return by accepting more risk. Risk tolerance is personal, so it's good to know yours before you commit to an investment. So you have to understand what kind of risks you can afford to take, you know? The next thing you're going to have to consider what you're investing for. I would say this is actually the most important thing is to have a clear goal because everything else you do in your investing journey is going to be built around your overall goal, and that's going to dictate every other decision you end up making. Having a clear goal in mind could help you decide how much you'll need to save, when you'll need it, and what type of account to put it in. There may be registered savings accounts that align with your goal and saves you taxes. The next thing you need to consider is whether you'll need access to your money. Cash and bank accounts are very liquid. That means it's fairly easy to get your money out when you need it. Investments tend to be less liquid than bank accounts. Consider different investments for different time horizons and make sure your emergency fund can cover sudden expenses if needed. What kind of investing help might you need? Getting advice can take many forms considering different types of advisors and whether one might meet your needs. If you decide to use an online advisor, understand how that differs from an in person advisor relationship. So, those are the things you need to start considering before we actually get into the mechanics of how to start investing. So, once you've, pondered on that and you've gone through all those considerations, the first step to investing in Canada is that you're going to need to figure out what type of account you want to invest in. Now, I'm going to break down what kind of accounts are available to you here in Canada. So, first off, you'll have your registered savings and investment accounts. In Canada, there are several types of registered accounts that can hold different types of investments as well as savings deposits. These accounts can also help you save for specific goals. One thing these accounts have in common is that they are tax sheltered. This means your savings will grow tax free while the money stays in these accounts. The different types of accounts, you have a tax free savings account, TFSA, saving and investing for any type of goal. Now, the name is misleading, but the real true purpose of a TFSA is to be a tax free investment account. The whole benefit of the account is that any gains you have inside of that account are going to be tax free. And a lot of Canadians, we don't actually appreciate, what we have with the TFSA, because something like things like this don't really exist in many other places. Even in the US, they have Roth RIAs that work a little bit differently, but those they can't even access until retirement. The TFSAs here we could access anytime. So that's really, I think, the best type of account that exists. And the only limiting factor is that you're going to have a contribution limit each year. It starts from the age of 18 and it does carry over. So if you're much older and you haven't been contributing to a TFSA, you'll still have all that room left from the past. So, definitely great thing to look into. The next kind of registered account is your registered retirement savings plan, or RRSP, savings for retirement. So what an RRSP is it's tax deferred, not tax free. So any growth, any gains you have inside of this account, you won't have to pay tax on it until you take it out in retirement. And this is an account you're not going to be able to access until retirement. And if you try to access it early, there's going to be a bunch of extra fees and taxes you're going to have to pay and a bunch of extra headaches to deal with. So this is really better for locking money away for retirement. The other tax advantage of an RRSP is that anything you contribute to your RRSP each year could be deducted from your income when you're filing your taxes. So that's another tax advantage. The next thing you have is a first home savings account, FHSA, saving for your first home. So in this account, it works similar to both a TFSA and an RRSP, where your gains are tax free. The only difference being you'll only be able to use this money to purchase your first home in Canada. Otherwise, for you to access the funds, you're going to have to pay penalties, or you could move it into your RRSP. The next type of accounts we're going to look at are non registered accounts. So, when you're starting, you probably want to focus on, maxing out your TFSA, contributing to your RRSP. But in other circumstances, there's cases when a non-registered account is going to be your best option. Now, the tax implications of a non-registered account, anything you make in this account is going to be taxed as capital gains. So you're going to have to basically report 50% of that as income. So there's two different types of non-registered accounts. You could have a cash account or you could have a margin account. So basically with a cash account, you're just buying shares with cash and you're holding the shares in the account. It also works pretty similar to the other accounts, the only difference being you don't get the tax advantages. Now, in a margin account, you borrow to invest. Investments bought on the margin cannot be held in a registered account. So, inside of a margin account, you're going to be holding a mix of assets that you've bought with your own capital and assets that you've bought with capital borrowed from the brokerage. It's a lot more advanced type of an account that you're probably not going to be looking at when you're starting out. But I will make a few future videos talking more about margin accounts and how to use margin and how to be safe with margin. So the next thing we're going to look at is what to invest in. Once you've decided what type of account you want to open and what type of account you're going to be investing in, the next thing you want to think about is what kind of assets do you want to be holding in these accounts? What do you want to invest in inside of these accounts? So we'll go through the different kind of asset classes and the different kind of things you can invest in. So An asset class is a group of investments that have similar levels of risk. Having investments from various asset classes helps diversify your investment portfolio. The term asset allocation refers to dividing your investments among various asset classes. Having a diversified portfolio will allow you to take advantage of the different strengths of each asset class while offering some protection from market ups and downs, known as market volatility. So we'll go through the different types of assets you can hold inside of these accounts. Now, the first thing is going to be cash and cash equivalents. So, this is going to be money in your bank account and investments that are generally very safe and give you quick access to your money, like a savings bond. Risks associated with these investments range from very low to medium, and returns are earned in the form of interest. These rates of return are relatively low compared to more risky types of investments. So, these are things that are going to be like cash, your high yield savings accounts, savings bonds, things like that. The next type of investment is fixed income. When you buy a bond or other fixed income security, you're lending money to a government or company for a certain period of time. In return, they promise to pay you a fixed rate of interest at certain times to repay the face value at the end of the bond's term, its maturity date. The face value or par value is the value the bond was issued at. Interest payments are based on the face value. The annual interest rate paid is called the bond's coupon. Bonds tend to offer better rates of return than cash equivalents such as guaranteed investment certificates or GICs or treasury bills such as known as T-bills. Because you're taking on more risk lending out your money for a longer period of time. So what fixed income is basically you're lending money and you're getting paid interest, and then at the end they're going to repay you your original investment. That's how fixed income works. The next thing is going to be equities. These are going to be your most popular types of investments. These are going to be like stocks. When you buy stocks, also known as shares or equities, you become a part owner in a company. You may be entitled to vote at shareholder meetings. Each stock you own represents a claim on a company's earnings and assets. Any profits the company allocates to its shareholders are called dividends. Compared to some other types of investments, stocks can be riskier but could potentially offer higher returns. The value of stocks could change very quick over a short period of time. So I'm sure we all know what stocks are. Those are the most common types of investments you're going to look at. And then the next thing you have is investment funds. These are going to be things like mutual funds, index funds, ETFs, investment trusts. Investment funds, like mutual funds, are a collection of investments from one or more asset classes. Funds will focus on a specific investment, such as a government bonds, stocks from large companies, stocks from certain countries, or a mix of stocks and bonds. When you buy an investment fund, you're pooling your money with other investors. This allows you to invest in a variety of investments at a relatively low cost. Most funds are managed by professional managers, freeing the investor from making complex decisions. Now, when you're starting out at investing, this is most likely what you're going to want to be focusing on is investing in funds, whether index funds or mutual funds or ETFs. You're going to want to be investing in these things that have built-in diversification. They're lower to medium risk, and fairly good returns. So this is where you're going to want to start building your experience, getting your exposure, seeing how things move. You could start buying a couple shares of an ETF that you like. The value of a fund will change as the value of what you invest in goes up, of what the fund invests in goes up and down. The amount of risk associated with a particular fund depends on what the fund invests in. So once you know what kind of account you want to open, what kind of account you want to invest in, and what kind of assets you want to hold inside of that account, The next thing you're gonna want to do is pick your brokerage. Now, what your brokerage is going to be basically the company that's going to house your account and facilitate, all your transactions inside of these accounts. So in Canada, any of the big banks in Canada also operate as brokerages, but they also usually offer less favorable terms. uh, you have brokerages like Wealthsimple and Questrade that are very popular in Canada. In my opinion, Wealthsimple would be the most beginner friendly platform in Canada. They're commission free, and they're just a very straightforward layout. And they have the option for fractional shares, which makes it great for people just trying to start out with small amounts of money and start learning. So basically, once you understand the implications, you've considered all the risks, and then you choose what type of account you want to open and what you want to hold in that account, and you've opened up your brokerage account. The only next step is to make the transaction and purchase, either purchase shares in the ETF that you want to invest in, or in the company that you want to invest in, or in the fund that you want to invest in. Or what you could also do with most brokerages is invest in a managed account where they will have the brokerage itself will have an asset manager basically managing your funds for you and investing your money for you. So that's another option for people that don't really want to get into, researching stocks and comparing different ETFs and things like that. So, yeah, that's my quick little breakdown of how you could start investing in Canada. Some of the safest things to start with would be ETFs like VEQT, which gives you broad global exposure to, developed markets, emerging markets, the Canadian market, the American market. So you're basically getting as broad exposure as you can. You have things like VFV, where you're getting exposure to the S&P 500.